The precious metals world just experienced a moment that few analysts saw coming, a seismic shift so dramatic that it has rewritten the risk and opportunity landscape for silver investors everywhere. What unfolded in the silver market over the past few weeks wasn't ordinary volatility. It wasn't a garden variety pullback. It was a historically violent reversal that wiped out gains in a matter of days. Silver, after an extraordinary run that captured headlines and imaginations around the world, suddenly faltered, shedding nearly a third of its value faster than almost anyone anticipated. Prices that had breached triple digits and delivered stunning profits to early bulls reversed course with breathtaking speed, leaving even seasoned market participants stunned. Today we are going to unpack that event with precision, exactly what happened, why it happened, and most importantly what it means for the months ahead. By understanding the forces at play, you will be positioned to think clearly about whether this dramatic drop represents a once-in-a-generation buying opportunity or a sign that there is more downside risk before the market stabilizes. To appreciate the scale of this move, let's begin with the raw numbers, because they tell a story that few people fully grasp yet. In early February, silver was trading in the mid-$80 range per ounce, levels that would be considered elevated by historical standards but not extraordinary compared to the parabolic moves seen in certain commodity bubbles. What was remarkable is that only days before, silver had pierced the $100 per ounce threshold, reaching what at the time was being declared an all-time high. That psychological and technical landmark represented the culmination of a months-long rally that had defied bearish forecasts and captivated investors searching for upside in a world of low yields, uncertain growth, and shifting monetary policy expectations. Many market participants had begun talking confidently about further gains, as if that breakout opened the door to entirely new pricing regimes. And then, almost as quickly as the sentiment turned euphoric, it collapsed. From its peak above $100, silver retraced nearly 30% in the span of only a few trading sessions. That kind of drawdown is not the consequence of typical profit-taking. It is the result of a feedback loop in which forced selling begets more forced selling. By the time the initial panic subsided, prices had slid down toward the $70 per ounce range. For anyone who entered the market near the highs, this constituted a devastating contraction in value. Positions that had been richly profitable were suddenly underwater, and many traders who had purchased on leverage were caught in margin spirals that exacerbated the selling pressure. At the time of reporting fresh market data from mid-February, silver had clawed back some of its losses and was trading in the mid-$80 range once again. That bounce, while encouraging to some, raises a critical question. Is this recovery the start of a sustained rally or merely a temporary counter-trend rally before another leg downward? Traders refer to this type of rebound as a dead cat bounce, a phrase that captures the idea of a short-lived recovery amidst a dominant downtrend. Distinguishing between a real turnaround and a fleeting rebound is central to any short-term trading strategy and vital for long-term investors weighing the risk-reward trade-off at current price levels. To understand why this crash unfolded with such ferocity, we need to look under the surface at the market structure, the positioning of traders, and the flow of speculative capital that helped create conditions ripe for instability. This was not a simple correction caused by shifting fundamentals in supply and demand. Rather, it was the culmination of several factors converging to produce what amounted to a perfect storm. Central to that storm was the dramatic increase in speculative activity, particularly through leveraged instruments such as futures contracts, options, and other derivative products that amplify exposure. When prices surge relentlessly, as silver did in the months leading up to its all-time high, traders and algorithms alike tend to increase leverage in pursuit of outsized gains. This behavior can work to extend a rally, but it also makes the market far more brittle. What many analysts have highlighted is that a significant portion of the buying pressure that pushed silver prices higher did not come from traditional sources like long-term investors or industrial consumers of silver. Instead, a disproportionate share of the demand was driven by speculative positioning, traders using borrowed capital to speculate on short-term price movements. When you have large concentrated positions in highly leveraged products, the risk of abrupt reversals multiplies. All it takes is a modest increase in selling pressure to trigger margin calls, which force leveraged traders to liquidate their positions. Once those liquidations begin, prices fall further, which triggers more margin calls, and the process cascades downward in a feedback loop. This dynamic explains how an initially small pullback can morph into a full-blown panic sell-off in a matter of days. Compounding the situation were adjustments in margin requirements by the futures exchanges that handle a large proportion of silver trading. In the wake of the initial sell-off, exchanges such as the CME Group raised margin requirements to safeguard against systemic risk in the face of elevated volatility. While such adjustments are designed to protect the integrity of the market, they have the side effect of putting additional pressure on leveraged positions, because traders suddenly need to post more capital to maintain their exposure. For those already underwater, this often translates into forced liquidation rather than a stabilizing move. Another dimension that analysts have pointed to is the role of foreign capital flows in the silver market. There was significant speculation that large pools of capital, including trading interests outside of the United States, entered the silver market in search of alternatives to dollar-denominated assets during a period characterized by monetary policy uncertainty and currency volatility. When large concentrated positions form in a relatively small market such as silver compared to global markets like crude oil or government bonds, the potential for outsized price impacts in both directions increases. A market that is thin relative to the size of capital flows funneled into it becomes highly sensitive to shifts in sentiment. Once we step back from the frenetic short-term trading behavior, it is important to separate that noise from the underlying fundamental drivers that influence the medium and long-term trajectory of silver prices. And here, the structural story remains compelling for many investors. The silver market has been operating in a consistent supply deficit for multiple consecutive years, with consumption outstripping mine production by a substantial margin. This persistent imbalance means that the market must rely on existing above-ground inventories to meet demand, which is a pattern that cannot be sustained indefinitely. Drawdowns of inventory can temporarily bridge the gap between supply and demand, but as stockpiles shrink, the market becomes increasingly vulnerable to shortages unless production increases or demand eases. This fundamental imbalance is not a fleeting phenomenon. It is shaped by long-term trends in mining output, technological demand, and macroeconomic conditions that influence investment demand. Even with short-term fluctuations in industrial usage or jewelry fabrication, the persistent supply deficit exerts upward pressure on prices over time, because it signals that newly mined silver is insufficient to meet the world's consumption without drawing down existing inventories. The idea that this structural context could continue to support higher prices over the long run is one reason why some investors interpret the recent crash not as a harbinger of prolonged weakness, but as a reset that offers a more favorable entry point after speculative excesses have been purged. It is also important to recognize the diversity within silver demand. Industrial use accounts for a significant proportion of total consumption, and while projections suggest some near-term softening in certain segments, other areas of demand remain robust. Technologies such as data centers, artificial intelligence infrastructure, and electric vehicles all incorporate silver for its unique conductive and reflective properties. Even sectors that are reducing silver intensity, such as certain solar panel manufacturers, are still major consumers of the metal in absolute terms. Jewelry and silverware demand tend to be more price-sensitive, contracting when prices spike and expanding when prices stabilize. The contraction in discretionary demand at higher price levels is an expected behavioral response, not evidence of a structural collapse in consumption. In addition to these supply and demand dynamics, broader macroeconomic conditions play a significant role in shaping precious metal markets. Expectations around monetary policy are among the most influential, particularly the trajectory of interest rates. When policymakers shift toward easing, reducing interest rates, or signaling that easing is forthcoming, non-yielding assets like silver and gold typically become more attractive. That is because the opportunity cost of holding an asset that does not pay interest diminishes as yields on cash and bonds fall. In environments where interest rates are expected to decrease, precious metals often benefit from increased investment demand, as market participants seek assets that can preserve capital in the face of currency debasement or weakening real returns elsewhere. Over the past year, weaker economic data in key markets has contributed to expectations that central banks might pivot toward easing to support growth. Slowing retail sales, soft GDP figures, and other indicators have led investors to price in a sequence of rate cuts that would reduce the cost of carrying non-yielding positions and make precious metals relatively more compelling. At the same time, questions about fiscal and monetary policy direction, including uncertainties in government budget negotiations and the broader policy environment, have contributed to demand for safe haven assets that can provide a hedge against instability in financial markets. In such contexts, silver can benefit not just as an industrial commodity, but as part of a diversified portfolio seeking protection against economic uncertainty. Silver's relationship with the US dollar is another macro factor that has exerted influence on prices. Commodities priced in dollars typically move inversely to the currency. A weakening dollar makes dollar-denominated commodities more attractive to holders of other currencies, effectively boosting demand. Over the last 12 months, shifts in the dollar's value have been among the drivers behind silver's gains, which have been sizable even after accounting for the recent downturn. If dollar weakness continues, as many analysts forecast in tandem with monetary policy easing, that alone could provide a substantive base of support for silver prices over time. While all of these elements frame the broader context for silver's valuation, evaluating where prices go next requires a careful synthesis of technical patterns, macro fundamentals, and investor psychology. The recent crash inflicted real technical damage, breaking price structures that had supported the rally to triple-digit levels. The depth of the drawdown and the speed of the reversal raise legitimate concerns about short-term trend continuation before any sustainable recovery can be confirmed. At the same time, the rebound into the mid-$80 range suggests that lower price levels attracted buyers, indicating that some market participants view the downturn as an opportunity rather than a signal to exit entirely. This clash between short-term technical weakness and longer-term fundamental support creates a dynamic in which volatility is likely to remain elevated. Traders and investors must navigate a landscape in which sharp reversals can and will occur, and where sentiment can shift rapidly as economic data, policy signals, and speculative flows evolve. For anyone considering entering or adjusting silver positions, maintaining a clear understanding of both the risks and the underlying drivers of demand and supply will be essential to making informed decisions. As we move beyond the immediate shock of the recent crash, the question becomes, what does this mean for investors looking at silver over the next several months and years? Understanding the interplay between market psychology, industrial demand, and macroeconomic factors is crucial. Even after a sharp 30% correction, the underlying structure of the silver market remains remarkably robust. Persistent supply deficits, growing demand from emerging technologies, and a favorable monetary environment combine to create conditions where long-term investors can find compelling value, despite the turbulence. While short-term traders must be prepared for sudden swings, the broader picture suggests that this correction may have purged over-leveraged speculative positions, setting the stage for a healthier, more sustainable uptrend if fundamentals continue to assert themselves. Industrial demand, though experiencing some softening, still underpins a significant floor for silver prices. Analysts project that global fabrication of silver for industrial purposes may decline modestly in the near term, largely due to efficiency gains and substitution in sectors like solar photovoltaic production. However, growth in technology-driven applications, including data centers, artificial intelligence infrastructure, and electric vehicles, continues to expand the structural demand for the metal. These applications rely on silver's unique conductive and reflective properties, making substitution costly or impractical. Even modest industrial demand in absolute terms supports a baseline level for prices, ensuring that extreme lows are unlikely unless there is a simultaneous collapse in both global manufacturing and speculative activity. Jewelry and silverware demand, by contrast, is highly sensitive to price movements. At the peak above $100 per ounce, many consumers pulled back from discretionary purchases, a normal reaction to historically elevated prices. This contraction helps explain some of the short-term softness in the market. However, if prices stabilize in the mid-$70 to $85 range, a resurgence of jewelry demand is plausible. Consumers often respond quickly to a return to perceived affordability, and this cyclical behavior can provide incremental support to the market, particularly during periods when speculative buying is subdued. Understanding these behavioral dynamics is key for both traders and long-term investors, because they illustrate how price-sensitive sectors can amplify or mitigate short-term volatility without altering the underlying structural fundamentals. Macroeconomic conditions are equally critical in shaping silver's trajectory. Expectations of central bank policy, especially the Federal Reserve, have an outsized influence on precious metals because they affect the opportunity cost of holding non-yielding assets. Recent economic indicators point to weaker retail sales, softer GDP growth, and other signs that the economy may be cooling more than anticipated. Markets are pricing in potential easing measures, including a series of interest rate reductions over the coming months. Lower interest rates reduce the attractiveness of cash and bonds relative to silver, enhancing its appeal as a store of value. The combination of monetary easing expectations, ongoing supply deficits, and steady industrial demand forms a confluence of factors that could support a rebound and potentially establish a foundation for long-term gains. Another factor underpinning silver's value is geopolitical and policy uncertainty. Investors often flock to precious metals during periods of instability as a hedge against currency volatility, fiscal uncertainty, or geopolitical shocks. Current conditions, including debates over fiscal policy and the broader global economic environment, continue to drive safe haven demand. The dollar's relative weakness compared to other major currencies over the past year has amplified this effect, making silver a more attractive alternative for international investors and portfolio managers seeking protection against currency risk. If these trends persist, they provide an additional layer of support beneath the market, particularly in periods when speculative sentiment has cooled. Technical patterns in the market reveal both the challenges and opportunities facing silver. Following the rapid decline from above $100 to the $70 range, silver established initial support and rebounded to the mid-$80 level. This action demonstrates that buyers are actively engaging at lower levels, which is a positive sign. However, resistance near $82 to $84 remains a critical test for the market. A sustained move above this zone would signal that bulls are regaining control and could attract additional speculative interest. Conversely, failure to hold above this resistance could indicate continued weakness, leaving the market vulnerable to further declines. Monitoring these technical levels, alongside volume patterns and market sentiment, provides important insights into near-term market behavior and potential inflection points. One of the most influential factors in short-term silver dynamics is the role of leveraged traders, particularly in futures and options markets. The market's recent volatility was amplified by concentrated positions and margin calls, demonstrating how leverage can exacerbate price swings. Going forward, the level of speculative participation will remain a key variable. Retail investors who suffered losses near the highs may be hesitant to re-enter quickly, reducing one source of buying pressure. At the same time, institutional and hedging activity could continue to stabilize the market, provided that margin requirements remain reasonable and liquidity is sufficient to accommodate flows without triggering forced liquidations. Watching these conditions closely allows investors to anticipate potential shifts in momentum and adjust strategies accordingly. Physical demand indicators are also essential for understanding silver's near-term prospects. Premiums on coins, bars, and other physical products reflect the willingness of buyers to pay for tangible ownership. Elevated premiums often signal strong demand that can support prices beyond the futures market, while falling premiums may indicate weakening interest or oversupply in the retail market. Observing these dynamics alongside macroeconomic indicators and technical charts provides a comprehensive perspective on where the market may be headed. Chinese market activity is particularly noteworthy, as traders from China played a significant role in the initial run-up and subsequent crash. Movements of capital into or out of the Chinese silver market, along with regulatory adjustments, can have outsized effects on global pricing and volatility. While risks remain significant, there are reasons why many investors view the current environment as a potential opportunity. Historical precedent shows that sharp corrections during a bull market often create attractive entry points for those willing to withstand short-term volatility. Silver's structural supply deficit, ongoing industrial demand in emerging sectors, and favorable monetary conditions provide a foundation for longer-term gains. Analysts suggest that in bullish scenarios, silver could regain the $100 mark and potentially reach levels as high as $200 per ounce over the coming year, provided that fundamental conditions remain intact and speculative participation resumes once market volatility stabilizes. Even the base case scenario, which anticipates consolidation in the mid-$70 to $85 range, underscores that the market is unlikely to collapse below the levels established during the recent crash, without a major shift in underlying supply-demand dynamics or an unexpected macroeconomic shock. Investors considering entering or adding to positions must carefully weigh their risk tolerance and time horizon. Short-term traders face an environment of elevated volatility, with the potential for daily swings of 5 to 10% or more. Effective risk management, including the use of tight stops, careful position sizing, and readiness to act quickly, is essential for those seeking to capitalize on intraday or swing opportunities. Long-term investors, by contrast, can focus more on structural factors, using the correction as a chance to accumulate positions at lower price levels relative to prior peaks. Even in this context, a measured approach such as scaling into positions or employing dollar-cost averaging can mitigate the risk of entering immediately before another leg down, ensuring that capital is allocated efficiently across potential price scenarios. From a strategic perspective, waiting for confirmation can be an effective approach. Establishing positions only once, silver sustains a breakout above key resistance zones, such as the $84 level, reduces the likelihood of buying into a bear trap. This method may sacrifice the chance to capture the absolute bottom, but it also decreases exposure to continued short-term volatility, allowing investors to engage with a clearer sense of market direction. Psychological preparedness is equally important. Understanding that silver may experience further swings of 20 to 30% in the near term, even after the initial crash, is crucial for maintaining composure and adhering to a disciplined strategy. Existing silver holders face different considerations. Those who purchased at levels significantly below current prices may have substantial unrealized gains, creating decisions around whether to take profits, hold for long-term upside, or diversify exposure. Investors who entered near the highs are confronted with losses, and the choices range from cutting positions to averaging down in pursuit of a lower cost basis. These decisions depend on individual risk appetite, investment horizon, and conviction in the longer-term fundamentals. The market's dramatic swings underscore that there is no one-size-fits-all answer, and highlight the importance of a tailored, informed approach that considers both short-term dynamics and structural drivers. As we look forward from the recent volatility, the technical picture for silver is critical for understanding where the market might go next. After the crash from over $100 to around $70 per ounce, silver has shown signs of resilience by rebounding to the mid-$80 level, but the road ahead is far from certain. Resistance in the $82 to $84 range represents a key test. If silver can break above this level and hold it as support, it could signal that the worst of the sell-off is behind us and that bulls are reclaiming control. Conversely, failure to surpass this resistance may indicate that short-term weakness persists, leaving the market vulnerable to further declines, potentially retesting $70 or even lower if the support fails. Volume patterns accompanying these moves are essential to monitor. High volume bounces tend to indicate genuine buying interest, while low volume recoveries may be easily reversed, leaving traders exposed to sharp moves against their positions. Volatility is likely to remain elevated in the near term. The speed and magnitude of the recent crash have left traders cautious, and even minor news can trigger outsized reactions in either direction. Short-term traders need to employ rigorous risk management, with careful attention to position sizing and stop-loss strategies. Markets prone to rapid swings require an active approach, where reaction times and disciplined execution can mean the difference between capturing opportunities and suffering outsized losses. The coming weeks, including periods of reduced liquidity such as the Chinese Lunar New Year, could amplify these swings, making the market more prone to erratic moves. Traders should be prepared for choppy trading and wider bid-ask spreads, particularly in markets heavily influenced by Asian participants. Margin requirements at major exchanges remain another critical factor. During the initial crash, the CME Group raised margins to reduce systemic risk, forcing leveraged traders to liquidate positions. Further adjustments in margin levels, whether increases or decreases, could significantly impact market dynamics. An increase may trigger additional forced selling, exacerbating downward pressure, while a reduction could alleviate stress on leveraged positions, stabilizing prices. Monitoring these changes is essential for understanding potential short-term catalysts in price movements. The dollar's performance continues to exert strong influence over silver. Historically, the relationship between the dollar and precious metals is inverse. As the dollar strengthens, commodities priced in dollars tend to weaken, and as the dollar softens, they gain value. Unexpected movements in the dollar, driven by economic data, policy shifts, or global events, can therefore have immediate and pronounced effects on silver pricing. Any significant reversal in the dollar trend, particularly if it strengthens sharply, could pressure silver prices lower even in the context of supportive supply-demand fundamentals. Conversely, continued dollar weakness would provide a favorable backdrop for price stabilization and potential upside. Federal Reserve communications also play a decisive role. Markets are closely watching speeches, FOMC meeting minutes, and economic data releases for indications of future monetary policy. Signs of aggressive easing could reinforce silver's appeal as a non-yielding asset, while a hawkish stance may increase the opportunity cost of holding precious metals, placing downward pressure on prices. The timing and interpretation of these signals require careful attention, as they can trigger rapid shifts in market sentiment and speculative activity. Investors and traders alike must remain vigilant and flexible, adapting strategies in real time to changing policy signals and their potential impact on market psychology. Physical demand indicators provide another layer of insight. Premiums on silver coins and bars reflect real-world buying interest and the willingness of investors to pay for tangible ownership. Rising premiums indicate strong physical demand that may eventually support futures prices, while declining premiums can signal weakening interest. Observing these trends alongside global inventory levels is crucial for understanding whether market participants are accumulating silver for industrial, investment, or speculative purposes. The Chinese market, which played a significant role in the initial surge and subsequent crash, remains particularly influential. Capital flows, regulatory changes, and domestic economic conditions in China can produce outsized effects on global silver pricing and volatility. Despite the array of risks, many long-term investors view the correction as an opportunity. Historical precedent shows that major corrections in bull markets often present the most favorable entry points. Silver's structural supply deficit, which has persisted for 6 consecutive years, combined with steady industrial demand, monetary easing expectations, and safe haven interest, supports a positive long-term outlook. Analysts envision scenarios in which silver could recover to $100 per ounce, and even approach $200 per ounce over time, assuming that macroeconomic and fundamental conditions remain supportive, and that speculative interest returns as market volatility stabilizes. Even in more conservative scenarios, consolidation in the $70 to $85 range over several months represents an environment in which accumulation strategies could be effective, particularly for investors with a long-term horizon. Investors must calibrate strategies according to their risk tolerance. Short-term traders face an environment of heightened unpredictability, where price swings of 5 to 10% per day are possible. Rigorous risk management, including the disciplined use of stops, careful sizing, and responsiveness to market changes, is critical. Long-term investors can focus on accumulating positions incrementally, using the correction to build exposure at lower cost points, while recognizing that silver may experience additional volatility before a sustained recovery. Dollar cost averaging can mitigate the risk of entering at suboptimal levels and helps investors navigate the uncertainty of short-term price fluctuations. Waiting for confirmation before committing substantial capital can also be prudent. A breakout above key resistance levels, such as the $84 zone, provides a clearer signal that bullish momentum is reasserting itself. While this approach may result in missing the absolute bottom, it reduces the likelihood of falling into a bear trap and enhances the probability that purchases will be made in a more stable context. Investors should evaluate their own capacity to withstand further drawdowns, ensuring that they are comfortable with potential 20 to 30% swings in the near term, and that the capital allocated is truly long-term money that can remain invested without immediate liquidity needs. For those already holding silver, decisions will vary based on acquisition price and investment objectives. Investors who purchased well below current levels may consider taking partial profits while retaining exposure to potential upside. Those who bought near the highs are facing losses and must decide whether to hold, cut, or average down. Each choice carries implications for portfolio risk and potential return, emphasizing the importance of individualized strategies informed by both fundamentals and technical indicators. Looking ahead, silver is likely to remain a dynamic and engaging market, characterized by volatility, opportunity, and complexity. Its trajectory will be influenced by a combination of technical factors, speculative flows, industrial demand, monetary policy, currency movements, and geopolitical uncertainty. Investors and traders who approach the market with a disciplined strategy, clear understanding of risks, and appreciation for structural fundamentals are positioned to navigate this environment successfully. While short-term volatility is inevitable, the persistent supply deficit, ongoing industrial applications, and supportive macroeconomic conditions provide a foundation for potential long-term gains. The recent crash, which saw silver decline from over $100 to $70 before rebounding to the mid-$80 range, represents one of the most dramatic episodes in the precious metals market in years. While the speed and magnitude of the sell-off were alarming, the underlying fundamentals remain supportive. This combination of short-term turbulence and long-term opportunity makes silver a market that demands careful attention, respect for volatility, and strategic risk management. For investors willing to navigate the complexity and maintain a disciplined approach, the current environment offers a potential entry point that could yield significant rewards over time. In conclusion, the silver market today is a study in contrasts. Rapid, speculative-driven swings, juxtaposed with enduring structural imbalances that underpin long-term value. The fundamentals, persistent supply deficits, robust industrial demand, favorable monetary conditions, and safe haven interest remain compelling. Yet the market continues to challenge investors with high volatility, technical uncertainties, and sensitivity to macroeconomic shifts. The path forward will require careful monitoring of key resistance and support levels, attention to speculative flows and physical demand, and an appreciation of broader economic trends. Whether for short-term traders or long-term holders, silver presents both risk and opportunity, rewarding those who combine strategic insight with disciplined execution. For those prepared to engage thoughtfully with the market, this is a moment that could define portfolio performance for years to come.